So now I want to talk about localizing the valuation estimation. And all I mean by that is how might we use these valuation metrics we've been putting together for the last 6 or 7 weeks, how might we use them for just a part of the company or a project in your company or an idea in your company to determine whether it's viable? How can we use these things? What we've done is we've used it on the whole company, but I'll tell you that the structure that we've utilized is virtually synonymous with if you're wanting to simply look at some little aspect of the company. You're going to have to determine what are the expected cash flows. So Kane, you put together in your company a new production line. You've got a big enough warehouse, let's say, that you were able to add a second production line within your existing square footage. You know what it's going to cost you to actually add that line, for the equipment and such. You know what it probably will cost you to hire more workers. You know what it'll cost you to train those workers. And you know that how many units of whatever the product is that you can expect to have run through that production line, right? All of those things are going to be relatively well known by you. And you're going to know what it'll cost you to put this all together. And in so doing, you can put together all of your cash flows from that new production line, not the entirety of the company. So there are some expenses that the company was already bearing that you're not going to add those into the expense of this because the company's already bearing those expenses. So this is marginal revenue. This is marginal expense. And we've got to think about how do we parse this out. So it's probably the change in our revenues or the change in our expenses that are attributable to this one project or this one innovation or what have you. I'm going to go through and give an example here in a few minutes of Mira Dravana in this case. And there's some complexity to the example, but I think you'll appreciate it. So we have to consider what's the discount rate that we're going to apply. Well, I guess the answer to that question is, how did we capitalize it? Did we capitalize this? And when I say capitalize, King, did you go ahead and authorize the acquisition of the equipment and training of these new people for this production line just by using existing cash? In which case, what's the opportunity cost of cash? Well, I think we can get what? 0.6% in a bank for savings or money market fund, something very small like that. That would be the opportunity cost. And or do we look at the opportunity cost as to what else we could have done with the cash if we were going to invest it in some non-cash equivalent? Or do we have to go out and borrow the money, in which case it would be the company's cost of borrowing? Or do we go out and raise equity, in which case it would be RE? Or maybe it's a combination, in which case there might be some weighted cost, but it's not going to be the whole company's cost of capital. We can isolate this down to what is the cost of the capital that we're putting into this one project or this one acquisition. So we get to be a little more granular and more circumspect with respect to this discount rate. We have to think about what the terminal value is going to look like. And remember that terminal value is the continuing value. Will we apply a Gordon growth structure to this as we have in the past? Will we apply a multiple to it? Or will we simply say we're going to acquire this production line and we believe that this product line that Kane wants us to work with is going to be outdated within 5 years, and so we're going to have to re-engineer, retool that whole thing in 5 years, and so we're going to sell that off or scrap it. So there's some salvage value maybe. So all of those things are important for us, as is what's the upfront investment. Well, all we're talking about now is the formation of a present value and a net present value and maybe some internal rate of return with respect to this project. Any generalized questions about this yet? You've actually been doing this all the way along. You've just been doing it with larger, more global numbers, right? So as we continue on then, we're going to look at an example for Mira Dravana. So Mira Dravana is not an insignificant company. It's got some pretty good revenues. We're going to see some of this in a few minutes. So I'm going to suggest that we, as the board of directors, the senior management group of the company, we have put together a proposal to buy a corporate jet. And I don't know if any of you have traveled by private jet before or corporate jet. It's much nicer than Delta Airlines. It's much nicer than going into first class with Delta Airlines. I have loved traveling by corporate jet in the past. So let's see if we can find a justification for a corporate jet. And by the way, if I can find a justification to buy a C8, I can find a justification to buy a new corporate jet. Okay. So let's see if we can do that using marriage of honor. And I'll share with you a model. In fact, you might realize that before class started, I shared with you a Google Doc or Google Sheet, and it is the sheet that I'm going to show you. And I'll actually go on to the Google Sheet as we play around here, so you can follow me there, or you can follow me on the screen, or both perhaps. So we're going to have to think about our revenue considerations. Well, in this case, I think a corporate jet might create some new revenue outright. If we don't use it all the time ourselves, we can rent it out on a timeshare basis, perhaps, to other businesses. That's not at all uncommon. It's thought of as fractional interest, and there's a whole industry that's been developed around that. But individual companies do that as well. Or we can think about what money we've saved on sending our executives around the world or across the country, what money we've saved in terms of time, and in terms of what we've been paying for their airfare. And these are going to be our corporate executives, so we're probably buying relatively expensive airfare for them, more often than not. But then we've got some costs to deal with. Fuel, maintenance costs, the crew, pilot, co-pilot, flight attendants and such, airport fees, property taxes, depreciation. All of this are costs that we had not been bearing before, but if we buy a corporate jet, we're going to have a ton of those costs. So is it going to make sense? Will we be able to justify this? We're going to end up putting this through a decision criteria funnel, just like we did on project investment selection with the different decision criteria we dealt with there. So will it make sense to us? Well, part of that's going to be determined by how we think about the terminal value or the long-term continuation value of this company or this jet. So I'm going to suggest that we're going to buy the jet, and then we'll go ahead and sell it at the end of the 7th year. And if we like having had a corporate jet, we'll buy another one. But I don't know that we want to have one that's more than 7 years old. I'm not interested in putting some of you guys as our senior executives in a jet that's all that old. In fact, we're probably going to buy a used one, because brand new ones are extraordinarily expensive if we want something nice. And so we'll go ahead, we'll maintain it well, and we'll sell it off in 7 years. And so we'll use a metric. We'll think about, when we sell it off, will we sell it off for a Gordon growth-like continuing value? Will we sell it off based upon a multiple that's established for selling used corporate aircraft of different types? Or will we sell it off based upon some expected sale price that we think we're going to get when we actually do that? So we'll look at all three of those quickly. And then what's our cost of capital? How are we going to capitalize this? So we'll look at each of these items with marriage Ravana. So I'm going to go ahead. You can I can either click on this, or I'm going to just go ahead and bring this up. And I've already posted the PowerPoint for you. So this link here is live, as well as I sent you an invitation to the sheet, the Google Sheet. Let me see if I can just bring this right up for us. Well, it doesn't want to come up for some reason. Why is this? Bear with me. Well, I'm not sure why that sheet doesn't want to come up. Let me pull up the Excel spreadsheet instead. It's the exact same thing. I was just hoping you could see it live. So I've got to think about revenue. I've got to think about expenses. Revenues I wouldn't have had, expenses I wouldn't have had, and then I'm going to put this all into a model, and I'm going to morph some of the terms that we've been using, because we've got to change them a little bit to fit within a localized scenario. Are any of you being able to bring up the Google Sheet?
Yeah, I'm in it. I'm in it right now.
Okay, good. I don't know why I can't bring it up there. I might have a dialog box open that I'm not seeing with everything else I've got open on my system right now. So what you should be looking at if you're bringing it up and what I'm looking at are literally identical. I merged these or copied it over just moments before class started. Everything that I have here in this model, I have input into this. In this case, in part because I have this as a standalone spreadsheet, but I also have it as a worksheet within the Miradravana spreadsheet. Okay, and so I brought in some numbers, and I'm going to start with my cost of capital number here and talking about how I got that and where I'm using it. In this case, I looked at the amount of cash available for Miradravana. So let's bring up the rest of the Miradravana sheet for just a moment. Not that one. So I bring up the rest of the Miradravana sheet. Come on. And I see that Miradravana has about $11 million in cash on the balance sheet at the end of last year. So we're making this decision here in January. And I don't know that I want to take the company down much further in cash than that. I'm not sure that Miradravana's got any excess cash on the balance sheet. So I'm not going to use cash. What do you say we go out into the market and raise some equity capital so we can buy a private jet so we can haul our wealthy rear ends around the globe? What do you think? I think that might be a hard sale in today's equity markets. That may be tough to sell. I think it might be politically incorrect, if nothing else. So I would like to stay away from that particular cattle prod. So that leaves us debt. And I know the company's got good debt capabilities, right? We already know that the company can borrow new capital easily. And so I've gone ahead and used a 7% cost of capital, suggesting that we can borrow against the company's assets, one of which would be this newly acquired jet. It can be collateral for its own loan, just like a house or a car or any other hard asset. And we can borrow money at 7%, so I'm using that as my cost of capital. Had I used cash, I would have used maybe 1% or less. Or I might have thought, well, I could have just as easily bought some other investment that should have given me 12%. I would have had some rationale as to why I'm choosing the cost of capital I'm choosing. And that's going to be specific to the scenario of the company and something about the project itself. I just think we'd have a hard time going out to equity investors and raising equity capital so we could fly around the country or around the globe in our private jet. Well, I'm also looking at some other variables here to help me with revenue and to help me with expense. So let me turn to revenue for a minute. And you're going to see I've put together in here a whole series of variables to help me determine revenue. And for different projects, different opportunity, the series of variables would be different. Okay, so these are just ones that I have chosen because I think they're the relevant ones with respect to identifying revenue for this opportunity. And revenue in this case may be overt revenue. It might be new cash revenue coming into the company, but it's also going to be money we've saved from not having some of the time spent traveling that you've been doing as executives, because that's valuable time to us, and not having to pay the airline airfare, because we've been flying you around the world first class, so your airfare is not cheap. So I don't care whether revenue comes from newly acquired cash or revenue is kind of a substitute for the term cash flow by being able to save some cash flow by not having an expense that we had had. Regardless, you've got to think about the change in overall scenario and overall picture for the company. So in this case, I'm suggesting that we've got 15 executives in the company that would be traveling, perhaps with this corporate jet. And each of those executives makes 48 trips a year. Now, a trip might be one day, so maybe they take a series of one-day trips in a week, or they go from here to Manhattan to Paris to Chicago, down to our Mexico City facility, and then back here all in a week. That would be then more than one trip. okay? So I'm saying that we've got 48 trips in a year for each of these executives. I'm averaging that they spend each about 6 hours of travel time, including airport time when they're traveling. But if we're able to travel by private jet, we're going to travel much more rapidly. We're not going to spend a lot of time in the lines at airports. We're going to have a much more efficient, much more comfortable experience. And there's a 30% time savings that I believe that we're going to have as a result of all of that savings at the airport, etc. I'm going to recognize that more often than not, we have more than one executive on the aircraft at one point, at any moment in time. In fact, more often than not, I've got 3 of you that are traveling to visit with a existing client or to make a proposal with a new client or our investment bankers or what have you. So I'm just working down this funnel here to try to determine my flight hours. And so I've calculated my flight hours, and there's nothing magical about this calculation. There's no valuation algebra. There's no model for this. This is just common sense. How do I use this information that I put in, just some common sense business thinking, to figure out what my flight hours are? Because you might know that the actual hard costs of corporate aircraft, aside from the acquisition price, is its hourly fuel charge, its hourly flight hour maintenance charge, its number of trip charges and such. So this nicely boils down to flight hours, and I might even think about the cost for the flight crew per trip. So you can see I've got all these set up, and you'll see these within the Google Doc exactly how I did the math. I'm going ahead and saying, hey, you guys are executives. I tend not to fly the janitor in the corporate jet. I tend to fly the senior executive whatevers. And I'm going to suggest that your average annual wage is about $250,000 per in that category of C-suite management. And maybe some of our more experienced, more productive salespeople or analysts are on these flights as well. And so, they're making some good money. We can estimate the wages per hour by taking that annual wage, dividing it by 52 weeks a year, and dividing that by 40 hours a week. I don't know how accurate that is, because last I knew, none of you were working a 40-hour week. You're executives. You're at the top of your game, but we might do that. I've input here that it costs about $1,200 each time I buy an airline ticket for you. If I lease the aircraft out or rent it out with timeshare, I can get about $1,500 per hour by doing that. And the entity that rents it from me is a triple net, so they pay all of the flight crew, the fuel, airport fees, everything. So that's just them using my aircraft, and they pay everything on top of that. So I believe we can get about 1,200 timeshare hours a year out of our aircraft. So looks like we're probably going to use it, based upon our estimations, about 1,000 hours a year ourselves, and that leaves a lot more time. So I'm thinking we can probably rent it out, if you will, share it out for $1,200 an hour. It costs about $1,000 to run a G3, a Gulfstream 3 for fuel, about $600 an hour in maintenance, and per trip there's an airport fee of about $300. That's a gate, landing, etc. And that's not at the main terminals for Delta. That's it's executive terminals. That's millionaire terminal. So over here, I've gone ahead and I've just used all these calculations to figure out what would my 1-year airfare savings be, what would my 1-year time savings be, what would my 1-year timeshare revenue be. And again, you've got the spreadsheet. You can look at the detailing of these numbers. There's nothing magical about how I put them together. I simply did so with some understanding of the numbers and just common sense about how you would think about these. And if it was a new production line, it'd be a whole different set of numbers. If it was a new investing in R&D for a new product line, it'd be a whole different kind of way of putting together numbers. You just have to be able to think this through. Any questions about what I'm doing so far? Okay. Well, I've also given here what I believe my annual revenue changes might be. I've come up with a revenue number, right, in each of a couple, 3 categories. So what might my annual changes in revenue be? Well, I think the airfare, I've seen that that's going up at about 4% a year. And that has to do with the amount of savings in airline tickets if I fly you on the corporate jet rather than on Delta or American. Your wages, including bonuses and such, happen to be going up about 10% a year. So I'm using that number. Now, these would be specific to the project and the company and such, right? I know in this that I also am going to have to purchase this aircraft, and a used G3 is going to cost me about $7.5 million. One that's been well maintained, one that's in excellent condition, that I wouldn't be bothered by using for a period of time, maybe a 7-year period, to fly you around the country or the world. I know that if I buy that, I can do a straight line depreciation over a period of 7 years. I know that there's a metric that's established for that kind of aircraft, that I should be able to have a 7-year resale ratio at about 40% of what I paid for it. So, which means if I'm going to sell it, my terminal value would be my purchase price times that ratio. Now, that ratio is specific to that type of aircraft, about the age that it would be. It's going to be different for any other kind of project that we might look at. All I'm doing here is going through and trying to identify my variables. And I'm doing so on a relatively well-informed basis, because I've done my research into buying a G3 in this case. Okay. So now we come to our forecast, and now it starts to look a little bit more familiar to you. But there are some things that are not all that familiar. So I don't have a base year here. Well, I put all my base year numbers together over here, right? I got all my base year variables here. So I could have created a base year. I don't. If you did this with a base year, that would be credible. Or if you did it without a base year here in one of your lines, it would similarly be credible. You just have to have the numbers to work from. So I'm showing you a slightly different organization of a forecast that I've shown you before. And we're getting our revenue and expense numbers not from an income statement and a balance sheet. We're getting them from some other variables that we've put together as we've thought this through. Okay? And here I've got now, instead of one revenue category, I have 3. I've got the travel expense saved, the travel time saved, and the timeshare revenue. Again, I believe that when we're not using the aircraft, that I can rent it out to other companies. They would have to use our pilot, our flight crew. They would have to pay for the maintenance per hour. They'd have to pay all this kind of on a triple net lease basis, if you will. This is a very common. Sometimes you put these together by long-term contract, like in fractional share, fractional interest relationships. Sometimes they're in just a one-time off basis, which is why they have to use our pilot, our maintenance crew, etc. So I then create a total revenue, and these numbers are literally just coming from the numbers that I picked up over there that I showed you a few moments ago. But we come up to a total revenue. Now I take all those facets and I come up with my fuel cost. So I'm using the executives, my trips, the hours, everything. I come up with my fuel cost. I come up with a maintenance cost. So I've got to have costs, operating costs, for each of the categories that I was able to think through. These are operating costs I didn't have before we had this corporate jet, or that I wouldn't have had without the corporate jet. Just as these are operating revenues that I wouldn't have without the corporate jet in this case. I come up with a cost for the crew. I come up with a cost for airport fees. I come up with my depreciation. And then that gives me a total operating expense. And notice I haven't had total revenue in other forecasting examples, but there's no reason we can't. I haven't had total operating expense in other forecasts, but there's, again, no reason we can't. What we have to have is each represented either in its whole or in its parts, so that we can come up with operating income, projected operating income, or in this case, EBIT. And then I go ahead and, using all the variables that I have, I simply forecast it out for each of these years. Now, years 1 through 7 are my explicit period, and year 8 is my continuation. I know that because I plan to sell it at the end of the 7th year. So I'm going to sell it based upon some numbers that may have come from year 8, just as I've thought about any other terminal or continuing value that uses the next year's cash flow variable. Any question conceptually about what we're doing here? These revenues are not the total firm revenues. These are new revenues, which in the case of the travel expense and travel time, they are a substitute for revenue. They're a savings. I don't care if you save me $1 in a company or bring me $1 of new revenue. It's still $1 to my bottom line. I don't care. So in this case, I'm treating them as though they're substitutes of each other. And I'm comfortable putting them together. And then I just total them and I do my various categories. Now these might be the correct categories. Maybe there's some that I'm missing here. Because frankly, I've never owned private aircraft or a corporate aircraft. I've flown in them, but I've never owned one for myself or a company that I've owned, of course. I've flown them for other companies. Well, now as you think about this forecast and you recognize why we have each of these categories, it comes up with an operating income, but I also have some other categories I might need to think about. I've got invested capital, but now we run into some pretty interesting differences. What is my invested capital? Well, it's what it cost me to invest in this project, right? So it cost me to invest, in this case, in the aircraft. So in this case, it is the capital I needed to commit to buy the aircraft. It doesn't include operating expenses. It doesn't include any net working capital. It's what it cost me to get into this thing. I could theorize some net working capital, but I've never seen that done. And I don't know why you would. I think you're making some generalizations that are far too broad. It's what it cost you to acquire, whether it's a production line, the corporate jet, what it cost you for the R&D project that you entered into, what it cost you for the big marketing campaign. You hired a Madison Avenue firm. And so to market, well, that's, you know, that maybe that's, you had to pay them $5 million for each of 3 years. Well, that becomes your invested capital. In this case, it's the $7.5 million that we paid for the aircraft. Well, I now am looking at something kind of like NOPLAT, but it's NOPAT. You might remember us talking about NOPAT on the very first night of class. Does anyone recall NOPAT?
Is it a profit after tax?
Exactly, Solomon. It's net operating profit after tax. So literally, it is my operating income, and then I am taking 1 minus the tax rate. Well, in this case, it's the same thing. There would be NOPLAT, but only because in this case, I didn't get to claim any tax credits. I took this straight off of the tax schedule, and because tax rates are now standardized at approximately 26%. If we had been doing this prior to January 1st of 2018, I would have had to expose this against a tax table that would be unique to the company's overall tax bracket, not unique simply to the tax bracket for that particular value. And that's where we differ from NOPLAT. In this case, because we have normalized tax rates at a flat tax regime, we are using the same number. This is no different than NOPLAT would be, but that's only because we currently have a tax plan where the tax rate is the same at any income level. I'm confident that tax plan will not be with us a lot longer. If we end up with a different administration in Washington in a year or so, then we'll start to see that unravel. Or if it's in 4 years or so, we'll start to see that unravel. I'm virtually certain, because that's how history has always played out. When we've put together a flat tax regime, it's always unraveled once the next administration starts to come in. I now have something called marginal cash flow rather than free cash flow. Well, why would I have a marginal cash flow, and what does that mean? Well, my marginal cash flow is my NOPAT plus depreciation, which might as well be a tax-adjusted EBITDA. Why would I do this rather than come up with a free cash flow for the project? Any ideas at all? Think about free cash flow. No plat, well, I'm kind of using that, right? Plus depreciation, well, I'm using that. Minus change in net working capital. Well, I don't have a net working capital that I'm attributing to the project or the acquisition of the aircraft. So that would be zero then, right? No change in net working capital. And you'll remember that we've capitalized this at a $7.5 million fixed asset, and we're not creating a net capital spending because we're not spending more capital on this asset. We spent the capital once. So there is no net capital spending. Solomon?
I was saying the marginal cash flow, basically, what I understood, maybe, does that mean you are using the money from the actual invested capital at the marginal cost because you're not going to get anything more than that after that?
That's a really good question, Solomon. What it means is this is marginal revenue minus marginal expenses. And when I say marginal here, I'm not talking about the classic economics term of marginality. I'm saying we are dealing with revenue we've created at the margin by having invested in this aircraft. So it's new revenue to us, right? The expenses are new expenses to it. They're over and above our existing revenue, over and above our existing expenses. They're attributable to this one project, so I'm calling them marginal. And I'm not calling it free cash flow because there's no change in net working capital and there's no net capital spending because I'm constraining it to this aircraft. I'm not buying a fleet of aircraft. So I'm not trying to grow that. It's this one thing. Now, maybe I would be using a series of growth opportunities where I put a new production line in each of 5 different facilities I have throughout the globe. I put one in each year. It depends, but for this example, I'm not adding to my investing capital. I've just invested one time, one thing, and I'm putting money into it. Okay? So I've got marginal cash flow. And then I've got RONIC, return on new invested capital. So this invested capital, this is new invested capital. So it's new capital I invested, in this case, to acquire the aircraft. So I've got return on new invested capital. What is different about this RONIC from any of the ROICs that you've seen before?
Not returning to scale.
Pardon me?
It's not a constant return to scale.
It's not constant. Why is that, Jason?
What are we using to calculate it? So,
well, what are the conditions under which we get changing returns to scale? The first and most important of them is that our revenues are changing at a different rate than our invested capital, right? So in this case, our invested capital isn't changing. We paid $7.5 million. It is what it is, okay? But our revenues are increasing at some growth rates. We said we thought those revenues would go up each year. So we classically have changing returns to scale. And in this case, it's an increasing return to scale. You can tell increasing versus decreasing by whether or not the return value, the return variable, is improving or declining. In this case, it's improving. In fact, in our first year, we had a negative return on invested capital. Okay, it is what it is. But by the time we're done with this experience, it's gone up rather a lot. Now, I'm not sure that that's a very impressive rate. So we may have to think about whether or not this is worth investing in. But all we're doing so far is we're running our forecasts so that we can make some credible or prudent decisions. And in this case, I've got the first 7 years of this forecast as an explicit period. I've been informed of that based upon this information that I happen to have put here. And this would be different based upon what my plans were, just as all of this would be different based upon my project or my plans. Just as this would be different, etc. Okay? So I've got 7 years of an explicit period. In fact, I'm going to go ahead and shade that for us just so we can remember it. And then I put down here some growth rates remember, we usually have forecast ratios down here. And the forecast ratio for our revenue categories is working the same as it did, but not for our expense categories. Not for our expense categories. So we could have put together a forecast ratio for them, but I'm not confident that fuel, maintenance, crew, etc. follows revenue. Whereas I normally am confident about that. And so in this case, I'm not confident about that. So these are no longer forecast ratios. They're growth rates in these various expenses. And these are changeable, of course. As are these first two. I just happen to have articulated them up here. Okay. In fact, I should have articulated this one up there as well. I'm going to adjust that in the Google Sheet here as soon as we're done with class. I would have liked to have had all my revenue changes up here and all my expense changes down here. Okay. So now what's it mean to us? Well, here I'm using something that you've seen 1,000 times now. I just want you to focus on the free cash flow model, which actually is just a discounted cash flow model. It's not a free cash flow model. It's a discounted cash flow with our cash flow being the marginal cash flows. And these cash flows are coming from exactly where you would expect them to come from. They're coming from the marginal cash flows over here. I'm just using them for my multi-columnar valuation construction now. Although I've got more going on here, because in this I want to determine more than simply present values. I want to determine my decision criteria, because remember, I'm doing this not to find the value of something that exists. I'm doing this to decide whether or not we should do this. This is a pro forma, it's a forecast. I've got to convince Nate, the CFO, whose favorite word in the human language is no. In fact, it's the first thing that comes out of his mouth every time I walk into his office. I got to convince him to back me up on this as we approach the rest of the board, because frankly, I like traveling by private aircraft, and I think we can more than justify it financially, but I got to make sure he thinks the same thing. So I've got to have my decision criteria in here as well, just as we did with the project investment selection spreadsheet or examples and such. So I take the cash flows, I take the present value of them, exactly as we always do. I divide each of the cash flows by 1 plus my discount rate, which is up in that corner, to the power of time, exactly as you would expect me to in every one of these. Then I take the total of those in a running total. And then I have the present value of the discounted cash flows. It says I'm using free cash flow here, but I am not. Correct those. So I take the present value of the discounted cash flows, and then I take my terminal value. Now in this case, this one, I put together this model based upon an asset sale. So we're going to sell this asset that we've acquired for 7.5. We're going to sell it for $3 million at the end of 7 years. We believe we're going to be able to get that for it because there's a pretty well-established market for luxury pre-owned private aircraft. And as it turns out, this is a G3, a Gulfstream Model 3. And after about 7 years of acquisition at high maintenance schedule, you can sell them for about 40% of what you paid for it. That's a pretty well-established, there's lots of literature on this. So I think if I'm going to sell it and buy another one perhaps, or buy a new one, because I don't want you guys running around in one that's too old, I should be able to sell it for about $3 million. Now, I might have done this as a salvage value. I might have done this as a Gordon Growth model example. But here in this case, I'm doing it as a terminal value based upon selling it. Now I'm going to take the present value of this because this $3 million I'm going to get way out into the future, so I need the present value of it today. And I add my two present values together to get the value using this, this particular model form. Any question about how I've gotten here? This is old hat for you guys now. You've done this a dozen times or more, right? But I want to now I want to know the net present value. Because remember, this present value of $7,625,900, I want to net out the $7.5 million I invested in this. So to do it, I can do this one of a couple of ways. Here I'm just taking the present value of the future benefits and I'm subtracting from it the cost of $7.5 million. Easy as pie. Or I can get the exact same number using the net present value function in Excel, which is why I now have these cash flow columns. So I got a cash flow column here, so I can use the cash flow or the net present value, the present value function. Okay. Remember that there's something different than we originally expected when we first looked at this structure. In the cash flows, I have not only used the cash flow from the last year of my explicit period, but I've used the terminal value. And that value is a number I expect to get as I sell it at the end of that last year in cash. So that's part of my cash flow. And part of my cash flows to do the NPV or the IRR for that matter is what it cost me to go into this as well, right? So I'm using the net present value cash flow or net present value function in Excel. Internal rate of return, I'm calculating exactly as we always calculate internal rate of return. I just use the internal rate of return function in Excel, picking up all of my expected cash flows, starting with the cash flow of me paying for this up front, and then ending when I actually have sold it here at the end of year 7. I'm also using modified internal rate of return. Gives me a slightly different number. I've got a profit index, and remember the profit index is simply taking the value of the benefits, present value of the benefits, divided by the present value of the cost in a ratio. Okay. If it's less than 1, I've got a problem. It means it's going to cost me more than it's going to give me. If it's, in this case, I know that I have some correlations here. That my net present value is positive tells me what? What does that tell me about IRR and profit index? Do you remember? When the net present value is positive, we're getting our benefits are greater than our costs, and it means our return that we actually get as investors is greater than our discount rate. So when net present value is positive, so greater than 0, then the return we actually are going to experience or we're projecting to experience is greater than the discount rate we used. Well, similarly, when the net present value is positive, means that the present value of the benefits is greater than the present value of the costs. And if we have present value of the benefits and cost in our profit index, benefits divided by cost, then our profit index is going to be greater than 1. If the net present value was 0, then the IRR would be 7%, the same exact number as my discount rate, and the profit index would be 1. The numerator and the denominator would be the same values. I did a payback period here, constructed 2 payback columns, and I see that in this case, I get a payback on cash flows, not including this amount that I sell it for, but just operating cash flows. I get a payback within the 7th year. So here, talking to Nate, the first words that come out of Nate's mouth after he gets over saying no is, how long is it going to take for us to recoup our investment? And I'm able to tell him we recoup it in the 7th year. And he might like that, he may not. But I'm feeding information into his decision-making funnel now. What comes out of it is a function of his preferences. But I'm feeding that information in so credible, rational decisions can be made, because at the end of the day, we are nothing if not professional financiers, right? And I'm taking a discounted payback. What is the difference between a payback function and a discounted payback function? Stevie, do you remember the difference?
I'm not really sure right now.
So, Scott, just thinking about the terms, what do you think the difference between the two would be?
Between the payback and the discounted payback?
Yep.
Isn't that just I want to say like there's a present value thing in there, but
No, exactly.
Probably.
Yeah, we're trying to figure out how long it's going to take us to get paid back our original $7.5 million using discounted cash flow,
Oh,
right? Because I mean, this payback
yeah. So you
thing,
just add them together. Yeah.
yeah, so that was nice. I was able to tell Nate, yeah, we can get this thing paid back, but if he's thinking about it, he's going to throw something at me because I'm paying it back with future dollars that aren't worth this amount in today's money. So he should come back at me and say, yeah, Rick, but what's the discounted payback period? In which case, I don't have one. I can't articulate one because in our 7 years of operating it, I don't have one. Now, if I included in this the dollar amount that I'm going to get when I sell this thing, of course I have a discounted payback. But we look at payback ratios or rates or time frames based upon the operational cash flows, not because we sold something. Okay? So I've come up here, and Nate, you're the CFO. You know it's going to cost us 7%, $7.5 million. We're going to make more than that. We're going to have a net present value that's about $126,000. We're going to get a rate of return that's greater than our discount rate. We get paid back in a 7-year period. Are you going to stand behind me as I propose this to the rest of the board and the shareholders? Sure he is. In part because he can be one of the first people who gets on this aircraft when we fly to Paris together, okay, to visit with some of our French clients. So this is a model we've used. Could we use a different form of terminal value? Do you know any terminal or continuing value forms other than thinking we're going to sell it at a point in time?
Could you map out the depreciation for it?
You know, I could. I don't know how relevant that might be, Scott. I haven't thought about that. But I thought, well, what if we use a continuing value like we use in the other Gordon growth value? What do you say? We know what kind of cash flow it's spinning off here in the year after our explicit period. And what do you say we take that and divide it by a discount rate minus a growth rate? Notice up here, I've got a long run growth rate. I don't know if I can necessarily apply that to this situation, but if it's long run, you know, I think I can. I mean, generalizing this, it fits the structure of any other valuation model we've used. So let's see if we can do that. So that's what I've got going on here in blue. Let me move this over a little bit. Make that a little bit bigger so you can see the numbers. And I've got the same present value of my discounted cash flows, right? Nothing should be different about them. But what the heck is going on here? I go from a terminal value of 3 million, knowing some established market metrics that say I can sell this thing for about 40% of what I paid for it, assuming it's got a near perfect maintenance schedule, I haven't crashed it, etc., versus a $30 million value using a Gordon growth construction as we have so many times with a cash flow model. Which one would I choose? They clearly are both dramatically different, so much so that one of them is just not credible. Which one do you think I would use?
I think the first one, because the second one is just increasing, and it's hard to believe that the value of fixed assets increase. It's kind of one of the simple basic logic that if you have a fixed asset which you're using for production or something.
I would tend to agree with you. Remember that this one for $3 million, as I indicated, was based on some established market metrics that we can observe, and you can find them published. That if you bought an aircraft and had it for about 7 years, maintained it very well, etc., you can sell it for about 40% of what you paid for it. Well, that's a big difference. In fact, this is not a 10% difference. This is a difference on a scale of 10. This $30 million is 10 times. So it's not even credible. So this kind of becomes a lead-in to one of the things we'll talk about before we're done tonight. Some model forms are appropriate for some firms or project and others are not. So this one would lead us to a honkin' net present value. By the way, I've got something wrong with this number here. I'll have to figure out what it is. It should be the same as this one. It leads us to a honkin' internal rate of return, modified internal rate of return, etc. But they're irrelevant to us. We've clearly applied the wrong model. And if I was actually doing this before I went to Nate or the board of directors, whomever I was using to help me run these numbers to understand the resaleability, the costs, etc., of owning a private aircraft, we would have done all of our homework. We would have researched this ad infinitum. I would have known that this would have been an improper model. But I wanted to use it for you. I wanted to show it to you so you could see that sometimes the model forms will give us very different outcomes. But that's because it's the wrong model form. You wouldn't use it for something like this. But what we might use is a model form using a multiple, a revenue multiple. So just as that 40% for a 7-year-old private aircraft is a fairly reliable number, if you have a private aircraft that's creating revenue, then you can sell that private aircraft for about 75% of its annual revenue value, or 1 year's revenue. There's another relatively, think of it as a 0.75 revenue multiple. Okay, so that's another relatively well-established number in aircraft ownership circles. So here I'm taking what essentially is the FMM model. I'm taking the present value of the discounted cash flows. I'm now applying a multiple to the next year's cash flow. Okay, so the multiple 0.75. Now I'm applying to the next year's cash flow or revenue out here, and you can see it all the way over here where I'm doing it. You would see it's picking up this marginal cash flow right here. That's it's picking up our revenue over here. This is our total revenue. So it's picking that up for the next period because it's a revenue multiple. And then I am applying it in my continuation term. Gives me about $3 million, a little bit less than. I take the present value of it, and then I take the sum of the present values. Now, interestingly enough, this aligns relatively well with the discounted cash flow and using this terminal value, which is established in the market, just as this revenue multiple is established in the market and gives us some interestingly similar net present values, this time a little under 100,000 rather than 126. Slightly different internal rates of return and modified internal rates of return, profit indexes, and such. So I've got 3 different model forms, all of which are being applied to this private new asset. And that's kind of interesting to me. And they give me very similar values if I'm using market metrics, and they give me a very dissimilar value if I'm using something that we might think about for some normalized firm as an asset. But a piece of aircraft or a production line or a printing press aren't normalized firms. So we have to think about them with a different valuation model form. Does all of that make enough sense? Did you think you can walk through this spreadsheet, this Google Sheet, and see what's going on, and then use similar thought processes to consider the estimating a value for a project in your company, maybe even for something you're doing a final term course project on? Does that make sense? And of course, I've designed this to juxtapose to what we've been doing as you now move into working on your course project. You might even choose to use this very model, which is why I've given it to you. I would dovetail it in to the rest of the model you're using, of course, for the rest of the firm's values. Okay? So, any question here before I move on? Okay, take a big breath. Because the hardest is behind us, we're now going to just talk about some generalizations. Okay? Let me go back to my PowerPoint. Okay, so we went through a lot there. And I do hope that made sense to you, and I hope you hang on to that file. I probably put about 4 hours into thinking through how to get the revenues, the expenses, and such. But again, I wasn't thinking about them as a valuation consultant or as somebody with the, a teaching evaluation course. I was thinking about them as making an executive level decision, and which is what this class is supposed to be about. But we've used the lens of valuation modeling to discuss and reveal to us the virtue of these decisions. So we can look at the mirror to a lot. And for some reason, I've got to come down here further. There it is. So we looked at interpreting model outcomes. Well, we just went through that. We used the same decision criteria we established in the second or third week of class. We just are now applying them to a localized scenario. We can think about the different model forms. The Gordon growth model, it might be appropriate for some model forms, but what's the problem with just using a Gordon growth model where we have a cash flow variable divided by a discount rate minus a growth rate? Why would we not necessarily use that in this localized decision thing? Well, it's a perpetual model, right? And we may choose to salvage the asset, sell it off elsewhere. We may not want to think about the asset in perpetuity. So the Gordon growth is great because it gives us some perpetuals or infinite cash flows that we can generalize algebraically very nicely, very neatly. But remember, it's also a little bit unrealistic because it takes and applies to all of the firm's future cash flows a long-run growth rate. And that's generalizing this so much as to maybe not even be credible. But it's done over and over and over. Or I can use a free cash flow model. Well, I use a free cash flow model the way that you've gotten used to the free cash flow model for a firm that's pretty heavily capitalized. It's got some good operating incomes. In fact, by the way, you'll remember that because when we were up here looking at forms here a little bit ago, let me go back to it, I said that we use EBITDA multiples and EBIT multiples for firms with good operating income. Well, same thing with free cash flows. And we use the free cash flow form of a multiple when the firm has good operating income and big capital growth plans. So this makes sense to us that we might use this sometimes. I would only use the APV model. Oh, excuse me, let me back up to KVD. I would use the KVD model for this kind of a thing or for a firm valuation if I was having a hard time forecasting the future cash flows in the continuation period. Remember the KVD form of free cash flow. No plat plus depreciation, no plat plus depreciation times 1 minus G divided by ROIC. Well, if I don't have change in net working capital, if I don't have net capital spending, I can go ahead and use the the KVD form because I do have ROIC, I do have G, and then I can use that. So I might use that KVD form when I don't feel comfortable forecasting out those two important balance sheet relationships, net working capital and net capital spending, which is a function of fixed assets, of course. I might use it there. I'm probably never going to use it on a localized decision, but I might use it on a global decision. I'm only going to use adjusted present value when I want to articulate a separate cash flow. In this case, coming from a tax sheet. Well, I didn't have that I was looking at here. For this firm or for this asset, I chose not to use that. I could have because I would have been borrowing the $7.5 million. It would have given us a tax shield, so I could have done that. But then I would have had to worry about articulating KU and K-tax. And I just didn't want to have to do that. Those are non-reliable enough. I probably wouldn't use them in a localized decision. In fact, I barely use them in a global decision. I can use my enterprise value multiples. And we've done that a number of times now. And as it turns out, for the particular project that I wanted to invest in, there happened to be some published multiples. In fact, there's a published multiple. So I was able to do that. If I didn't have something like that, I couldn't do it. If it was a production line, I couldn't do that. If it was R&D, I couldn't do that. But in this case, I was able to because there is an established multiple that helps us value aircraft, just as there is to help us value real estate and some other nice tangible assets. I wouldn't want to only apply the enterprise multiple. I don't like that. That's as broad a brushstroke as when I apply just the Gordon growth model. So I chose to use a hybrid. I used a forward market multiple, and I did so because I had a good cash flow. I didn't want to generalize it too much, but I did want to recognize the applicability of that market multiple. Okay. What questions would you have about any or all of this?
I'm guessing they'll probably come as we go along.
Well, I think so, Scott. And in fact, I'm going to suggest that we have a call together or a study session on Thursday evening. And if some questions have come up after you've been looking at the spreadsheet and such, and looking back at this PowerPoint, maybe even looking at the video, some questions come up, you're certainly welcome to ask them then. I think that you should have some questions as you're thinking about your project, because I end, this is our last night of classes, I end with this structure because it then launches off into you completing your project analysis, right? Okay. Anything else you might like to discuss this evening?
Rick, on the model we just went through for the corporate jet,
yeah,
the growth rates for the operating expense, did you say where you got those?
Yeah, I would, because I spent about 4 hours researching corporate jets.
Oh, okay,
in
gotcha.
advance of spending about 4 hours putting together the spreadsheet. I've never had a corporate jet that I've owned, of course. I mean, good grief. I drive a Hyundai, okay? I'm barely about to buy another C8, or buy a C8. So, well enough, G3. So
yeah, that was my question, is just it was research and not layered in there.
This is all very specific to the project. Yeah. And as much as possible, I went out and found these numbers. It does cost about $1,000 per flight hour for fuel. It does cost about $600 of maintenance per flight hour. Going into these private air terminals, about $300 per trip, etc. So the aircraft crew, all of this was, and even the timeshare revenue per hour, I was able to find information about that for the target aircraft I was looking for. As it turns out, people that have and finance aircraft are geeks, and they have all kinds of metrics out there, and they have all kinds of published material about it if you want to satisfy yourself.
Nope, thank you.
You bet. Okay, so if there's no questions, would you guys prefer a later evening study session like 9 or 9:30 on Thursday night, or a 6:30 in the early evening? Who would like to see a later evening? Just show me hands.
I'm fine with both. Any of the numbers,
fine with-
whatever majority decides, I'll just join you guys.
Scott and Taylor, Emilio, Stevie, G, could you pipe in on this? So if you'd rather have a later evening, just come off of mute. You don't have to say anything. You can just come off of mute, and I can count that as a vote. So Taylor would rather have it later. Stevie would rather have it later.
I'm fine with whatever.
I'd probably rather have it later as well.
Okay.
I also said late evening in the messenger.
Well, and to be perfectly honest with you, it makes it easier for me to do the same thing. So let's plan on 9 o'clock. And I'll send out an invitation to everyone for that. It's optional, of course. It's the last one we're going to have, though.
Okay.
Okay. And I'm not
That's
going to be very
9
available.
tomorrow?
I'm not going to be terribly available on Sunday. So take advantage of it.
So is this 9 o'clock tomorrow night?
Thursday.
Thursday. Okay,
Thursday.
Thursday.
Thank you for asking, Emilio.
Cool.
Yeah, so it's far enough away from now. You got time to look at these things and reasonably have an opportunity to come up with some questions. And please take advantage of it, because it's the last exposure we've got before you jump into your projects and finish them, as well as a few of your other final assignments. I want to talk very briefly about Leland Manufacturing. So I'm going to bring it up for a minute, and then we're going to be done.